Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about Walmart and Alphabet. What are their similarities and what can we take away from how the market is pricing both these companies? So, from the initial observation, a lot of you might be wondering, what's the connection between both of these companies?
Like, what's the connection?
Why have you picked a supermarket retail chain? I mean, now they've gotten into online as well, but largely, predominantly a supermarket retail chain with some online business, mainly in the US, and Google, which is in a completely different industry altogether. And they're looking at stuff like AI and they're looking at advertiser revenue. So there is a connection. And the connection is in the fact that how the market is looking at both these companies. So Alphabet is a very fast growing company. It's very profitable. It has very high profit margins. Its revenue over the past 5 years has grown at an average of 18% compound rate. And its return on equity over the same period has been an average of 24%. This is a pretty good number. Walmart grows at about twice the rate of the GDP growth in the US and is decently profitable. Its revenue compounds at about 5% per year and its average return on equity is around 16%. So given the borrowing costs, both of these companies are doing quite well. They're not a net destroyer of capital. So that's something which is common between both of them. And yes, Google does a little, that is Alphabet or Google does a little better than Walmart in some metrics, growing little fast, quite a bit faster and giving you better return on equity. So why is there a difference between both of them? Well, it's sort of obvious. Alphabet has a monopoly on search and they have had an antitrust ruling against them for this same reason. And online advertising, most of the online advertising goes to Google. So they get to set whatever margins they want to set on this. And it's relatively capital light because they don't need to actually go and put up physical billboards everywhere. It's more of just one particular code. Once it's done, it can be rolled out for every Google user. And yes, there are server costs, but that's much less on the margin compared to, let's say, a billboard, which you're going to put up for every new advertiser. So whereas Walmart is a hugely capital intensive player, you need to build up a whole supermarket, needs to be up to your safety standards.
Supply chain.
Yeah, supply chain. You need to locally supply certain goods. And for you to expand into a different country means all sorts of regulations. Yes, Google also has those regulations. But there are a different set of regulations when you actually want to open a, physical store somewhere. And those regulations fall upon Walmart. And if Walmart, suppose, wants to come to India per se, they would have to figure out Indian suppliers, figure out what works in the US, what works in India. And there's a lot of things which they have to iron out before they can successfully launch in a country like India. However, if Google, and it is in India, and when they wanted to come into India, there wasn't much they had to do apart from let Indian content creators onto their platform to ensure that the Indians knew what the Indians wanted. So Google didn't have to play an active role to figure out what India wanted, as long as they gave the platform for Indian users to come on and subscribe to whatever content they wanted to, and they would show whatever advertising which Indian advertisers wanted to show these people. The algorithm remains sort of similar. So this is the difference between Walmart and Google. And the fact is, Walmart's return on equity is lower because of the higher costs involved with running a business like Walmart. But here's the punchline. Walmart is trading at a PE of 28 and Alphabet is trading at a PE of 21. This is interesting. It's interesting because I just told you that Alphabet is growing at a much faster rate than Walmart. It's giving you a higher return on equity than Walmart. Then why is it that Alphabet is trading at a 21 PE, whereas Walmart is trading at a 28 times PE? Do you have any guesses or any ideas on why this may be so?
I think it's just a bias in the market. I think brick mortar companies always get valued because they have physical assets. And Google, people don't think of it as a brick mortar company having physical assets. And market always seems to, especially in weakening markets, when markets are overvalued, they tend to fall onto safety nets. And these safety nets are brick and mortar companies because they can understand that they are physical assets you can actually tangibly see and understand. Well, in terms of Google, yes, they do have offices and all that. They do have server farms and all that. But like AI and everything becomes intangible, and you really do not know what is happening. And it can, as an investor, it can look rather vague and looks little scary for you when you don't understand it. When you talk about all the technologies which goes behind it, Walmart is a very simple, basic business model which anybody can understand. You buy a product, you slap a margin on it, and you sell it at that margin. You factor in all your overheads and your cost to it, and you make a profit. Basically, running a mom and pop shop at a huge upscaled level. While Google, on the other hand, like you said, in India, when Google entered India, there was no regulations for internet. The web did not really have any. No one even thought of what the internet was going to become. It was a wild, wild west. The WWW, it was like the wild, wild west, and anybody and everybody was there. And Google, when it started its search engine, it was a very small company and could have global reach and global access with anyone. Wherever you could get internet, you could get into Google. And now governments all over the world are playing catch up for regulations there. Walmart could have never entered India like that or anywhere like that. So these things make a big difference. And as an investor, like I said, physically you're in Walmart, you're inside of the United States, and you're under United States laws and regulations, so you feel very safe. You can't get blindsided. While a company like Google, Europeans can demand certain things, earnings can go out the window, or certain things can happen on Asia, can approach Google and force Google to behave in a certain way, which can all be very foreign to you being an American investor, is what I feel. Maybe I'm wrong.
So, you got most of it. It's basically a safety premium which people are willing to pay for Walmart, because during a recession, no one knows how advertiser revenue is going to go. We haven't had a protracted recession ever since Google has become the giant it has been today. But one would assume that if the economy slows down, then Google will take a huge hit. But the kind of goods that Walmart is supplying, which is clothing and cheap groceries, that's something which people will always need, and arguably need more during a recession, because cheap groceries are a sort of inferior good. Yeah. So inferior goods, for those of you at home, is basically a good which goes up in demand when incomes go down.
Yes.
So when people are poorer, or that is income-wise, they're poorer relative to where they were before, they purchase...
It's their own perception, of course.
Yeah, of their own perception. They purchase cheaper goods, and Walmart supplies these cheaper goods. Whereas if people are richer, they're going to shift away from Walmart and go to Whole Foods or go to Trader Joe's or any of those, whole organic farming and all sorts of fancy products.
Yeah. Those so-called premium labels.
And
what you say is absolutely true, because in the news I read a few days back that Costco has been clamping down on people piggybacking on each other on their memberships. Because Costco is very famous that you pay a membership and then you walk inside and you get it at a very cheap wholesale rates.
Yeah.
But you have to sign up for Costco. It's not available, and no one off the road can walk into it and buy it. And users have been piggybacking because the economy in the US is showing the signs of it, because if, like Sashwath says, people are flocking towards wholesale prices, they're flocking towards unbranded jeans and unbranded food. That means there is certain pressure points in the market which are showing.
Yeah.
And rightly so. And Walmart will be a company which investors would feel is a safe bet to ride through a recession.
So that's the thing. We don't know how the AI bet is going to pan out for Google, Alphabet or Google. And we don't know exactly how regulators are going to come down upon these AI companies. And even if you isolate the AI story for a minute, even the regular business of advertiser revenue, it's going to be difficult to see how that advertiser revenue is going to pan out, because the antitrust ruling just happened and we don't know exactly what kind of, cure, or rather prescription, which the courts are going to have for Google or Alphabet. And it's going to be difficult for us to foresee this. And this is why we see that the PE ratio for a company like Walmart seems to be much higher than a fast-growing company like Alphabet, because Walmart is more recession-proof. At least that's what the market believes. And it's trading at a 40% premium compared to Google, when you compare its earnings to price.
Yeah, and a great way to understand Google's revenue in advertising, since it's not gone through a recession, is to wind the clock back and look at great advertising firms which were used to be listed, which are not there anymore. The great large American advertising companies which were listed in the stock market, if you roll back the clock about 20 years. And you can see them, how their revenues dipped and earnings dipped during times of recession in the US, because one of the first things that takes a hit is advertising. And when advertising dries up, these companies do layoffs and, they tighten their belts. And you can see how it affects an advertising company, recession effects. And that kind of an implication you can read out and say, maybe Google will go through something similar if a lot of people stop advertising. Because even in Twitter, after Elon Musk took over, that whole episode, a lot of brands walked away from Twitter, and Twitter's earnings took a beating. And Elon Musk tried all kinds of ways, one from threatening, cajoling, then having tantrums, trying to get advertisers back to Twitter. And it's not been easy for Elon Musk, because Twitter's basic revenue is advertising. That's why he's trying to create a subscription base, saying if you subscribe to me, you use subscription Twitter, you will not have any advertisements, and trying to push out advertisers altogether and hope that will at least, but even that has not really worked for him. And now it's a privately held company. We really do not know what's happening inside Twitter, other than whatever Musk thinks we deserve to know. Rightly so, it's his company now anyway.
So that's all we have for you today. And if you enjoyed this video, please hit the like button. Please subscribe if you haven't already. Hit the bell icon to get notified of when we upload our latest video. Finally, if you have any opinions or comments which you'd like to express, please leave them in the comment section below and we'll take a look at it. Thank you again for watching, BH.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.